Chapter 10, S2 Exit Signals. The exits are almost more important than the entries because it doesn't matter how many good trades you can enter, all that matters is how many good trades you can exit. So without understanding the exit strategies that we use every single day in the VTF, the entries are literally almost worthless. I need to make sure that you understand how to book profits. Please write this at the top of your page for this chapter. Rule number 576 that Austin said in this course. Book profits. You need to net the profits. It is the only thing that will keep you alive as a trader. Think about what I just said. Booking the profits is the only thing that will keep you alive as a trader. I know that's a little, kind of silly, almost too simple to say, but it's a fact that if you are very aware of it to the point where you get it tattooed on your face almost, you will succeed in your endeavor as a day trader. Now let's get into the strategies that we are using every single day to exit S2 trades. The standard take profit level for any S2 trade has always been 15 pips. And I'll be perfectly honest with you. As I've gotten more advanced in my own trading, I'm learning new ways to let these trades run longer. But when I first got started with the S2, we based the entire strategy off math. So the only logical thing then to do was to come up with the take profit and stop loss levels based on math. We already discussed how the stop loss was 8 pips plus your spread and the reasoning behind that. The reason for the take profit level at 15 pips for every S2 trade on every currency pair, no matter what you're doing, is because we've done thousands of hours, thousands of chart markups to prove the winners and losers of the S2 trade. We've then taken all of those numbers, averaged them out, and come to the conclusion that the average S2 trade will go about 20 pips. Now you're going to say, well, why would I put a take profit at 15, Austin, if you're telling me the average trade is going to go 20 pips? The reason that we're always going to use a 15 pip take profit is because you can never go broke taking profits. You can never be wrong putting the money back into your account. Even at 5 pips, even at 8 pips, you can never go broke taking profits. Please understand that. So the reason that I chose 15 instead of the average at 20 is because to err on the safe side would mean that I'm winning more trades over the longer period of time, and we know now that the key to winning and trading is actually just surviving. So if I can just book the 15, book the 15, book the 15, and I'm going to win more than I would if I was going for 20 or 25, that's the path that I would choose to take, especially when I first got started trading. Another really important exit strategy that I'm going to explain to you in a minute is the 8 EMA break on the 15-minute chart. We did go over this last chapter, but I'm going to show it to you again a little clearer here, how exactly you will see the trend will continue down, continue down, continue down. A large candle might close up and actually close its body back within that 8 EMA, back within the mustard. And that's going to be a sign to us that the downtrend in this example has stopped and we are now either entering consolidation or entering a reversal. So the break of the 8 EMA is always going to be a safe exit strategy. A lot of times when that happens, when you do catch me doing it, you'll see on my Instagram or my Twitter or in the VTF, you'll see me say, yeah, I pulled it here, pulled on the break of the 8 EMA, I lost 3 pips. I lost literally, you'll lose a spread. It's crazy. It's such a small loss that you won't even, literally you'll go on with the rest of your day. It'll be 4 o'clock, you'll be at the gym lifting weights or on the treadmill, and you'll be like, wait a minute, I don't even remember if I lost today or if I won today or if I traded today, because the loss is so small when you close on the break of the 8 EMA, because it's pretty much at break even when you do these trades correctly. For the most part. That's not all the time, but for the most part. Sometimes you'll close on the break of the 8 EMA, you'll be 30 pips in profit. Just take the profit when it breaks the 8. But keep that in mind as well, that if the trade does not break the 8 EMA and it's moving through the pivots and it hasn't reached its ADR, which we're going to go into in a second, then you might want to actually say, this is a really good trade. I want to stay in this trade. And that will come with market experience. I know I'm going to say this and no one's going to listen to me, but don't try to go for 30 pips when you first start doing this. Don't try to go for 20. Book the 15, book the 15, book the 15, book the 15. One more time, book the 15. Just net the profits, please. As time goes on, with working with our team and in the VTF, I will teach you how I hedge out of half my position and I move my stop loss. I'll teach you how I move my take profit with a trailing stop loss. I'll show you all the little tricks that I've developed over the last couple of years trading. But for this video course, for the intro to the S2 for you, just take the 15 pips and write me a thank you letter. And I'll take my Rolex in gold and silver, please, with diamond numbers. Thank you very much. The next exit strategy that we're going to go over is pivot points. I've already explained to you why I have pivot points on the charts in my earlier chapters. Here, we're going to show you how I use them as take profit levels. Just to give you a little bit of perspective, if you're trading a trade and a pivot point is, let's say, 30 pips away from your entry, that's a great opportunity for you because you have a lot of space to get your 15 pips that I'm telling you the average S2 trade will get. Does that make sense? If the pivot point is 30 pips away and you're trying to get 15, there's plenty of space for you to go place a trade in there and get 15, 16, maybe even more out of that position. Now, if the pivot point is 8 pips away and you're entering a trade, you might not even get to 15 pips because the pivot points are very strong levels of support and resistance. So be mindful of that when entering a trade. A lot of the time in the VTF, you'll hear me say, no, I'm not getting in this right now because it's too close to the pivot. Wait for it to break the pivot and then let's see if we get an entry. So use the pivots to keep you out and to help you exit. We're also going to touch on average daily range because that's a huge piece when qualifying a trade. If the pair has reached its average daily range, how much more do you think it could go? Probably not that much, just based on the averages. Just like I told you when the average trade goes 20 pips and we take 15, if ADR is reached, why would I max it out? Why would I assume it's going to go to 110% instead of 100% of its ADR? You can't do that. You want to find pairs that have only gone 30% of their ADR today, meaning they have 70% of their ADR, their average daily range, left over. You want to find pairs that have space to move. You want to also find pairs, like I said earlier, that have not been overbought or oversold. If you're in a trade and a pair hits overbought or oversold, that's a great time to start considering taking profits. We've already seen examples throughout this course where it hits overbought and continues to go higher. That's fine. I'm telling you, for this strategy, we use the overbought as an exit and we use the overbought to keep us out of trades. We will not be going long when the RSI value is over 70. And if you're in a trade and you hit 70, call it a day because we've seen it too many times where overbought actually means overbought and it doesn't go any higher. There's a reason it's called overbought and don't overlook that. Like I said already, the take profit is a predetermined price level that your trade is going to be closed out at. And for the S2 strategy, we're always going to shoot for 15 pips. The majority of the chart markups that I have shown through the 3-4 years that I've been doing backtesting have all proven that the average trade will go more than 15. So to take the 15 pips, you're almost guaranteeing yourself a higher win rate. Here you can see a live trade of mine. I have, in this example, 3 positions on USD JPY, all shown here with this black horizontal dotted line going across the screen. You can see my stop losses are labeled below because we're in a buy position, so stop losses are going to be below. And above the entry price, you can see I have 2 take profits here at the daily 1 pivot, and I have 1 take profit a little higher than that, about 9 or 10 pips higher than that, just in case we got a breakout of that pivot and I could catch a little bit more of the move. But you can see 2 out of 3 of my positions had their take profit levels right here at the pivot point. If you calculate it based on price, you can see I entered at about 107.15. Right here at that pivot point is 107.30, 107.29. That's exactly 15 pips. So this was a great trade where I would look at this as it was presenting and I would say, listen, this has exactly 15 pips to the pivot. That's like someone throwing me a sign. Someone threw me a life raft and said, hey, you got room to the pivot, you got space on ADR, and your 15 pip take profit could be hit. What are you waiting for, my friend? Jump on the boat. Let me give you an example of an 8 EMA break. Again, this is when the candles close back within that yellow EMA, back within the mustard. And this is just a simple signal that the short-term trend has been broken. And if you take profits here, whether you're positive, negative, or break even, you're going to be better off in the long term. Just get out of the trade. If you entered and it comes back and closes within the 8 EMA, get out. Because if it's right and it's going to continue in the direction you thought, it will throw another S2 entry, I promise. That might be the most important thing I've said the entire course so far. That if you get out because you realize you did something wrong, that's perfectly fine. Just don't give up. Wait on it because the S2 entry might actually present and then you'll miss the opportunity you were looking for. So just because you're early does not make you wrong. You're going to get in early. Any new trader is going to enter early at least once in their life. I promise. It's unavoidable. I still do it, and I've been doing this for 3 years. Trust me. Stick with the pairs that you're looking at. Be confident in your analysis. Very rarely are we wrong, just early. Let me show you an example of the 8 EMA break. You can see here, we're in a clean uptrend. Now let's not look at the EMAs or anything else. Just look, you have the RSI crossing the liquid 50 in the buy zone. You get a push through the 800 EMA. You expect more move higher, but what happens right here in this one bar? Complete retracement of the last, let's say 5 or 6 candles, 7 candles on the 15-minute chart. So a very strong push down and a body through the yellow line. You see how that closes through the yellow line? It actually closes through the 13 EMA too. So not only does it break the 8, but it breaks the 13. That's a huge signal to us that this uptrend that we were riding, if you were going long in here, the uptrend is over. I want you to also take note here, look how the RSI hit overbought. So just like you're going to use candlesticks, EMAs, time of day, and TDI to confirm your entries, use multiple indicators to confirm your exits. If the RSI is hitting overbought and a candle comes back in within the 8 EMA, dude, that's 2 exit signals. Come on. Don't be greedy. Just come back tomorrow. The market will be there tomorrow. So use multiple exit strategies in combination with each other to find your proper blend of exit characteristics. Another example here, clean downtrend, nice movement down, holding the 8 EMA, holding the 8 EMA, holding it, and then boom, a little break right there. So you would say, Austin, if we entered here and we didn't have a take profit in and we just let this fall, we could close here and still make money. I'd say absolutely you could, but you won't ever see me doing that. You'll never see me ride an entire move like this. 1, because it hits oversold. 2, because I always take 15, 20 pips and I stop. Because I'm a firm believer that you can get rich off of 15 pips. With big lots and consistent winnings, you can absolutely make a fortune off of 15 pips. Just keep that in mind. You don't need this entire move. Use the 8 EMA breaks to get you out if they're shitty. This 8 EMA break, if you have any positions in left at this point, God help you. Jesus Christ. You know what I mean? Take your money. Don't be greedy. I think I gave this example already earlier. I used to tell everybody, because I like ribs, you don't really like the ends of the ribs unless you're like a weirdo, because there's just not a lot of meat on them. You want the middle of the rack. That's where all the meat is. I don't need the entire move. That's all that I need right here is the middle part of the meat. Let's talk about average daily range. It's not too complicated. You should understand it just based on the 3 words of the title of this slide. Average daily range. This is the average number of pips the currency pairs will move in a given day. Some pairs, like GBP NZD, GBP JPY, these crazy cross pairs have bigger average daily ranges. They're more volatile, and there's more volume involved in them sometimes. If a pair has reached ADR, you're going to avoid trading it. You also want to avoid trading pairs with small ADRs. During the wintertime, seasonality has something to do with the Forex market. During the wintertime, some pairs will slow down. ADRs will go to 20, 30 pips in a day for weeks at a time. Don't trade those pairs. You need more than 30 pips of room to try to make your 15. You're not going to likely catch half of the day's move when you're trading. But if the ADR is 170 and you're trying to get 15 pips, how hard do you think that could be? Just wait for the S2 entry and it'll be pain-free. Also, touch on daily pivot points again. We're going to use these as take profit levels and to keep us out of trades, because the markets are going to always look to trade in between these pivot points. So if you're in a trade and you're up 10 pips and you're finding that it's slowing down at a pivot point, take your trade. Pull out, take the 10 pips profit and be happy. Don't extend yourself trying to go for the 15 and trying to expect some crazy push through a pivot point that, without you even knowing it, could be a support or resistance level for days or weeks or months. You don't even know, because we don't do analysis on high time frames like that. We just use the daily pivots and know and trust in the math that these indicators are going to tell us where the levels of support and resistance actually are. Another example of the pivot points on my chart, you can see the purple lines. This is where the market looks to trade between, and we look to find support and resistance there as well. Again, the purple lines, with the white pivot point right through the middle of the chart. You can see as you get bodies through these pivots, it has no problem continuing to move through them. But very rarely will you see it reach all 5. This is a very abnormal day, and that's why I left it in here. I wanted you to see how no matter what, it will still use these pivots as support and resistance. You have 2 hits to the level here, a body through the level here, a body through the level here, a body through the level here, pin to the level, retest of R4, and then a move through R5. So it's going to either body the level or find it as resistance and then retest the previous level of support before going back to that new resistance and trying to break it. So one more time, it moves up, finds resistance, moves back down, confirms this level as support, moves off it, and breaks through that previous level of resistance at R2. Good. Moves up, breaks the level of resistance at R3 with another body. Same thing, breaks the level of resistance at R4 with another body, and then moves to R5 with pins before retesting R4, confirming it as support, and breaking the resistance at R5. Now, when you see my charts, you're going to see that they get a little faint. I explained this a little bit earlier. Here, I don't need them bright purple. You don't need it super bright white. You just want to vaguely get an idea of where these pivot points are. And you can see when this market starts, so here you have the Asian session right here, and then by 3 a.m., London starts. London goes right to the pivot point, does not body it, puts wicks to it, and comes off of it all day. Very interesting, right? There's no coincidence that the market just stopped there. I have the pink line boxed in. You can see that's the reason for the market stopping there is because of that pivot point. 100%. Again, just a few examples of what my pivot points look like. You can see here is the support 1 for the day. We get the body through support 1 here. Consolidation at support 1, but does not break back above it, doesn't break above the 13 EMA. Move off of it to support 2, a retest of support 1 again, and back to support 2, and through it. So when it tests a new level and then confirms it, meaning here it set the level as resistance. It dropped, found support at the next pivot. Came back up to the previous pivot and confirmed it as resistance. When it moves off that pivot, you can expect that this is now a strong level. You have 2 hits to the level. You can expect that to be a strong pivot point for the day. I want to discuss also how important news is. There's a few news events that we always want to be aware of because we're never going to want to trade into high impact news. We're never going to want to hold a trade if there's important news being released on that currency pair. I'm also not going to trade into a news event, meaning I'm not going to take a position and say, all right, I know NFP is coming out in 5 minutes and I'm holding through. You'll never want to do that with the S2 pattern. The reason for that is because the S2 pattern is mainly technical. It's, if not all, technical. So when you throw the fundamental news into it, it screws with it. It just messes it up. I can't give you an exact reason any more than what the historical backtesting has showed us, and that is that if you avoid trading news, you will find a higher win rate with the S2 pattern. Some of the news events that I want you to avoid. Do not trade the first Friday of every month with NFP. I don't care what your other trader friends on Facebook or Instagram are saying or Twitter, whatever. In the VTF on that Friday, all we'll be doing is analysis every first Friday because there's too much emotion that comes into the market when those unemployment numbers come out. You also have FOMC meetings. Those are big news events that sometimes lead to a lot of consolidation. PMI and CPI are also 2 important news events that are released weekly or bi-weekly on most currency pairs. And you also want to be aware of bank holidays. If there's a bank holiday, for example, Martin Luther King Day was a few months ago, we would just not be trading. If it's a US bank holiday, I would not trade at all because 80% of the market is transacted through the US dollar. So if the US banks are closed, just take the day off. There's no reason to trade. There's a million trading days left in your career. Don't force yourself to get all emotional and screw up on a bank holiday. However, if the Italian banks are on a holiday and on the news website that you get your news updates from, it says Eurobank holiday, but it's really only the Italian banks that are closed, I'll still probably trade that day. If all the European banks are closed, definitely not trading. So you want to, 1, ask other traders that have been trading the S2 pattern a long time about the news events that they avoid trading, but 2, give yourself time to experience these news events and understand how to react to them. The worst thing you could do when reading news is not trade or trade on a demo account, see how you handled it, see if your predictions were correct, and then come back to it. But I'm telling you, you can trade every day of the week. I don't care if it's Monday, Tuesday, Friday, doesn't matter. Do not trade into high impact news or before high impact news. It's just safer. Doesn't matter anything more than that. That's all I should need to say to justify it to you. And the historical chart markups confirm that logic. Stay out of the emotional, guys. We're focused technical traders. Just stay out of that stuff. Here's an example of what news looks like when you go to forexfactory.com. You can see during this day we had a lot of medium and low impact folder news. That's the yellow and the orange folders on the dollar, the yen, the Swiss franc, the euro, and the pound. But then here at 10 a.m., we have high impact consumer confidence news for the US dollar. I would look to not be holding any USD trades at that time. If it hits, 10 a.m. comes out, no market shaken, market doesn't get shaken up, the candles don't go crazy, everything is fine. I'll be back at 10:15 with the next 15-minute candle to start trading. During this day, April 24th, you would not see us trading any NZD or AUD pairs. Why? Because they're on a bank holiday all day long. So just avoid it trading them. Go find GBP, JPY, Swiss franc trades. Stay away from AUD and NZD on days when they're on bank holidays, or any pair for that matter. So now we've gone through chapter 9 of all the S2 entries with the candle formations, confirmed on the TDI, confirmed with the market structure, confirmed by the time of day. You now understand the exits, ADR, pivot points, take profit, and EMA breaks. So now I'm going to give it all to you together, show you all 3 time frames, and walk you through S2 trade examples. Winners and losers, start to finish, exactly how I see it and exactly how we're going to trade it every single day together in the VTF. So let's get into the chart markups in chapter 11.